Stop refreshing that portfolio screen. What you're watching right now isn't a correction. It's not profit taking. It's not even a market adjustment. At 9:47 a.m. Eastern, silver touched $117.73, the highest price in human history. 4 hours later, $103.89, $14 per ounce, gone. But here's what they're not telling you on Bloomberg. Samsung didn't just liquidate because of tariffs. There's a clause buried in Executive Order 1.346, Annex 2, subsection 4, that makes what happened today legal. The same banks that crashed silver in 2011 just pulled the exact same playbook. And if you're holding physical right now, what I'm about to show you in the next 12 minutes changes everything. Welcome to Currency Archive. I'm speaking to the professionals today, the business owners, the folks who have been around long enough to know when something doesn't smell right in the markets. If you've been watching silver, gold, or precious metals for years, decades even, and you want the strategic intelligence they won't give you on CNBC, do me a favor right now, hit that subscribe button below. Not for entertainment, but because what we analyze here could protect your portfolio when the next shoe drops. And drop a comment, tell me where you're watching from today. New York, Dubai, Singapore? Let me know you're paying attention. Because what happened in the last 4 hours? This is just the opening act. On Tuesday morning, January 27th, 2026, at exactly 9:47 a.m. Eastern Time, silver reached $117.73 per ounce. Traders in New York stared at their screens in disbelief. Analysts in London called their editors. Investors in Singapore watched history being written in real time. This was not just another price movement. This was the highest price silver had ever traded in recorded human history. The previous all-time high from 1980 had been shattered. The 2011 peak of $49 had been left in the dust months ago. Every resistance level that technical analysts had mapped out for years, silver had blown through them all. The bulls were celebrating. The stackers who had bought physical silver at $18, $25, $32 per ounce were finally vindicated. The analysts who had predicted this moment were taking victory laps on financial television. But something was wrong. At 9:52 a.m., just 5 minutes after the historic peak, the sell orders started appearing. Not small orders, not retail investors taking profits, large blocks, institutional-sized positions, thousands of contracts dumping onto the market in coordinated waves. By 10:30 a.m., silver had dropped to $113.40, still high by historical standards, but the velocity of the decline caught traders off guard. This was not normal profit-taking. Markets do not move this fast without reason. By 11:15 a.m., silver had fallen to $109.20. The drop was accelerating. Trading desks across Manhattan were on the phone with risk management departments. Portfolio managers were watching positions that had been profitable just 2 hours earlier, now bleeding red. Then came the announcement. At 11:47 a.m. Eastern, Samsung Electronics issued an emergency statement through the Korea Exchange. Due to newly implemented tariffs on South Korean technology exports to the United States, the company was executing immediate liquidation of its commodity hedge positions to maintain operational liquidity. The statement was brief, corporate, almost routine in its language, but the implications were catastrophic. Samsung held $2.3 billion in silver-backed derivative positions. These were not speculative bets. These were carefully constructed hedges designed to protect the company's manufacturing operations against commodity price volatility. Samsung uses silver in semiconductors, in display technology, in photovoltaic cells for its solar division. For years, these positions had been stable, profitable even, but the new tariff structure changed everything. Under trade restrictions announced by the Trump administration just 72 hours earlier, South Korean electronics manufacturers faced a choice. They could either restructure their commodity hedging to comply with new Treasury Department regulations, or they could liquidate those positions entirely and revert to spot market purchasing. Samsung chose liquidation. And when a $2.3 billion position hits the market in a compressed time frame, it does not matter how strong the underlying fundamentals are. It does not matter that industrial demand for silver remains robust. It does not matter that supply deficits continue to widen. Physics takes over. By 12:30 p.m., silver had crashed to $106.15. The trading algorithms had joined the sell-off. Stop-loss orders were triggering in cascading waves. Margin calls were going out to leverage traders who had bought into the rally using borrowed money. By 1:45 p.m., the carnage was complete. Silver settled at $103.89 per ounce. In less than 4 hours, nearly $14 per ounce had been erased. A 6.55% decline in a single session. For those holding leveraged positions, the losses were multiples higher. Some traders saw their entire accounts wiped out. But here's what the headlines did not tell investors that afternoon. The volume patterns were wrong. When organic selling pressure builds in a commodity market, it shows up gradually across multiple exchanges. Traders in different time zones react to news at different speeds. Selling pressure disperses naturally across futures contracts with different expiration dates. This was not organic. The selling pressure concentrated on near-month COMEX contracts. It hit the market in synchronized blocks across a 4-hour window. And most tellingly, it occurred during a period when physical silver demand was surging in Asian markets. In Shanghai, physical silver premiums spiked to 11.40 per ounce above the COMEX paper price during the exact same 4-hour window. In Mumbai, dealers reported premiums reaching $9.80 over spot. Physical buyers were rushing to purchase metal while paper markets were collapsing. This divergence revealed something critical. The crash was happening in the derivatives market, in the world of contracts and leverage and margin requirements. But in the world of actual physical metal, demand was intensifying, not weakening. The people who control the paper-silver market had pulled a trigger. They had used Samsung's forced liquidation as cover to execute something much larger, something coordinated, something that had been planned in advance. And the evidence was sitting right there in the trading data for anyone who knew where to look. 3 days before silver crashed, a senior compliance officer at Samsung's Seoul headquarters received a 47-page legal memorandum from the company's Washington regulatory team. The subject line read, EO 1.346, Annex 2 compliance deadline, action required. She had never heard of Executive Order 1.346. Most people had not. The order had been signed 18 months earlier, buried in a broader package of trade enforcement measures that received minimal media coverage. Financial analysts had skimmed it. Commodity traders had ignored it. Even most corporate counsel departments had filed it away as standard regulatory paperwork. But on page 23 in Annex 2, subsection 4, there was language that would change everything. The subsection granted the Treasury Department emergency authority to mandate commodity rebalancing actions. For any foreign corporation holding more than $500 million in precious metals, derivatives, if that corporation became subject to new tariff classifications under national security provisions. The language was deliberately vague. It used terms like rebalancing instead of liquidation. It referenced national security without defining the criteria. It established thresholds that seemed arbitrary, $500 million, but precise enough to target specific corporate actors. Samsung's silver hedge position was $2.3 billion when the South Korea technology tariffs were announced on January 24th. Samsung's legal team spent 16 hours analyzing the implications. The tariffs themselves were significant: a 22% duty on semiconductor exports, an 18% duty on display panels. But it was the regulatory cascade that followed which created the crisis. Under the new tariff classification, Samsung was now considered a strategic technology entity operating in competitive commodity markets. This designation, buried in subsection 7 of the tariff announcement, triggered the Executive Order 346 compliance requirement. The company had 72 hours to either restructure its commodity positions to meet new Treasury guidelines or liquidate them entirely. Restructuring was impossible in that time frame. Liquidation was the only option. But here's what made this mechanism so effective. Executive Order 1.346 did not just target Samsung. It did not even specifically target South Korean companies. The order established a framework that could be applied to any foreign corporation, in any sector, holding significant commodity derivative positions. The Basel III banking regulations had already laid the groundwork. Under Basel III, standards implemented between 2023 and 2025, banks were required to classify their capital reserves into 3 tiers. Tier 1 capital was the most secure: cash, government bonds, gold held in allocated form. Tier 2 capital included certain corporate bonds and subordinated debt. Tier 3 capital was considered the most volatile, and it included commodity derivatives beyond a certain threshold. When a corporation like Samsung held silver derivatives as operational hedges, those positions were held through banking relationships. The banks that facilitated these hedges were required to allocate capital against the risk. Under normal circumstances, this was routine banking business. But Executive Order 1.346 introduced a new classification: systemic trade stress events. When a tariff action reached a certain magnitude, again, the thresholds were vague. The Treasury Department could declare a systemic trade stress event. For Samsung, this meant the capital requirements to maintain their silver hedge positions would jump from $340 million to over $1.5 billion overnight. No corporation keeps that much excess capital sitting idle, so they liquidate. And when they liquidate, they are not selling into a calm market over weeks or months. They are dumping positions into a compressed time frame during maximum volatility with every other market participant watching. The genius of this mechanism was its legal immunity. Samsung was not being punished. The company was simply complying with regulatory requirements. The Treasury Department was not manipulating markets. It was enforcing national security trade provisions. The banks were not coordinating a takedown. They were following Basel III capital rules. Every actor in the chain had legal cover. Yet the outcome was a coordinated $14 per ounce crash in 4 hours. But there was something else in the trading data that revealed how carefully this had been planned. Between January 20th and January 26th, 3 major banks reduced their net long silver positions by a combined 47,000 contracts. That represented approximately 235 million ounces of paper silver, roughly $27 billion in notional value at peak prices. They were not buying, they were selling, quietly, systematically, in the week before the tariff announcement. And in that same week, unusually large put option positions appeared in the March and May silver contracts. Someone had placed bets worth $340 million that silver would fall dramatically, with strike prices clustered between $105 and $100 per ounce. Those options expired worthless for years. Last Tuesday, they paid out spectacularly. The framework was not hidden anymore. It was operational. There's a photograph that circulated among precious metals traders in May 2011. It shows a trading floor in Chicago. The timestamp reads 2:47 p.m. Central, May 1st, 2011. In the foreground, a young trader sits with his head in his hands. His screen shows silver at $42.18 per ounce. Just 3 days earlier, he had watched it touch $49.82. His entire account had been wiped out. Not because silver had lost its fundamental value, not because industrial demand had collapsed, not because a supply glut had emerged overnight. He was wiped out because the CME Group, the exchange that operates the COMEX silver futures market, had changed the rules 5 times in 9 days. They called it volatility management. Traders called it something else. Between April 25th and May 5th, 2011, the CME raised margin requirements on silver contracts 5 consecutive times. Those who could not post additional margin were automatically liquidated. Their positions were closed by the exchange. Their losses were locked in. And the selling pressure from these forced liquidations created a cascading effect that drove prices down further, triggering more margin calls, creating more forced selling. By May 5th, silver had crashed to $32.93 per ounce, a 34% decline in 4 days. The young trader in that photograph was not alone. Thousands of retail investors, pension funds, family offices, and commodity trading advisors saw positions built over months or years destroyed in less than a week. But here is what made 2011 significant for anyone watching the events of January 27, 2026. The playbook was identical. On Tuesday morning at 11:15 a.m. Eastern Time, precisely as Samsung's liquidation orders were hitting the market, the CME Group issued an emergency announcement. Due to extraordinary volatility and systemic risk concerns, margin requirements on silver futures contracts would increase immediately by 340%, not gradually over days, not with advance warning, immediately. Traders holding positions at 11:14 a.m. suddenly needed to post triple the capital by the 2 p.m. settlement window. Those who could not were automatically liquidated into a falling market. The mechanics were surgical. A trader who had purchased 10 silver contracts at $110 per ounce was required to maintain approximately $35,000 in margin under normal conditions. If the trader did not have an additional $84,000 sitting in their account, the exchange closed their position at market prices during maximum volatility, with no appeals process. The forced selling added fuel to the crash already underway from Samsung's liquidation. But the margin increase did something else equally important. It prevented new buyers from entering the market. When silver was falling from $117 to $103, there were investors who saw opportunity. Value buyers who understood that physical silver fundamentals had not changed. Contrarian traders who specialize in buying panic-driven sell-offs. Under normal margin requirements, they could enter the market with manageable capital. But at 340% increased margins, the cost of establishing new positions became prohibitive for all but the largest institutional players. The selling pressure was amplified. The buying pressure was suppressed. And while retail traders and mid-sized funds were being crushed, a different group of market participants was executing a very different strategy. Between November 2025 and January 20th, 2026, 4 major banks had accumulated massive short positions in silver. These were not small speculative bets. These were institutional-grade short positions totaling approximately 174,000 contracts, equivalent to 870 million ounces of silver, worth roughly $87 billion at peak prices. Short sellers profit when prices fall, but holding short positions in a rising market is expensive and dangerous. As silver climbed from $89 in November to $107 in January, these banks were sitting on enormous unrealized losses. They needed an exit. The January 27th crash gave it to them. As silver plummeted from $117 to $103, these banks systematically covered their short positions. They bought back contracts at $108, $105, or $102, prices far below where they had established shorts in the $89 to $94 range. The profit was staggering. Exchange settlement data reviewed 3 days after the crash showed that between 11 a.m. and 2 p.m. on January 27th, approximately 89,000 short contracts were closed. At an average profit of roughly $18 per ounce, this represented approximately $1.6 billion in realized gains for those four institutions, while retail investors lost an estimated $34 billion, while leveraged funds were liquidated, while pension accounts holding silver exposure saw retirement savings evaporate. The banks covered their shorts at maximum profit. But there was one more element that made the 2011 playbook so effective in 2026, legal immunity. In 2011, after the crash, several lawsuits were filed against the CME group alleging market manipulation. Every single case was dismissed. The courts ruled that commodity exchanges have broad discretionary authority to modify margin requirements during periods of extraordinary volatility. The definition of extraordinary volatility? Determined by the exchange itself. The timing of margin increases? Determined by the exchange itself. The magnitude of those increases? Determined by the exchange itself. There was no oversight, no appeals process, no regulatory body with authority to question the exchange's decisions in real time. The same legal framework that protected the CME in 2011 protected them in 2026, and the traders being liquidated had no recourse. The playbook had been tested, refined, and deployed again with perfect execution. At 2:17 p.m. Eastern on January 27th, while COMEX silver was settling at $103.89 per ounce, a bullion dealer in Shanghai posted a different price on his board, $115.29 per ounce, for immediate physical delivery, a premium of $11.40 over the paper price in New York. In Mumbai, another dealer was quoting $113.69 for 1 kilogram bars. In Dubai, the premium had spiked to $9.20 over spot. In Singapore, buyers were waiting in lines that stretched down the block, willing to pay $114.50 for silver that the COMEX said was worth $103.89. This was not a small discrepancy. This was not a temporary arbitrage opportunity. And this was evidence that two completely different silver markets now existed on the same planet. One market was controlled by exchanges, regulated by governments, dominated by banks, and operated through electronic contracts that represented claims on silver that might never be delivered. This was the paper market. And on January 27th, this market said silver was worth $103. The other market consisted of actual metal, coins in vaults, bars, and allocated storage, physical inventory that could be picked up, weighed, and verified. This market said silver was worth $115. The gap between these two prices represented something far more significant than a trading anomaly. It represented the collapse of trust in the paper system. For decades, the paper-silver market had functioned as the price discovery mechanism for physical metal. When COMEX said silver was $25, physical dealers around the world sold at $25 plus a small premium for fabrication and delivery. The system worked because participants believed the paper price reflected actual supply and demand dynamics. January 27th shattered that belief. When investors in Shanghai watched New York silver crash by $14 in 4 hours due to a South Korean tariff announcement and exchange margin manipulation, they asked a simple question. What does that price have to do with the actual availability of physical silver? The answer was nothing. Samsung's forced liquidation did not create 235 million new ounces of silver. The CME's margin increase did not discover new mines or expand refining capacity. The banks covering their short positions did not change the fact that global silver supply runs a structural deficit of approximately 180 million ounces annually. None of the mechanisms that crashed the paper price affected physical reality, and sophisticated buyers understood this immediately. Within 6 hours of the COMEX crash, physical silver dealers across Asia reported the highest single-day volume in their operating history. Buyers were not waiting for prices to fall further. They were accelerating purchases, recognizing that the paper price had disconnected from physical availability. This created a strategic problem for anyone holding silver through financial instruments rather than physical allocation. Exchange-traded funds that track silver prices, bank certificates that promise silver backing, futures contracts that settle in cash rather than metal, derivative products structured as silver exposure. All of these instruments had just demonstrated that their prices could be manipulated downward, regardless of physical market conditions. But there was a second implication that went beyond price discovery. The Samsung liquidation revealed how fragile industrial silver supply chains had become. For years, technology manufacturers had relied on financial hedging rather than physical inventory to manage commodity price risk. Samsung did not stockpile 3 years of silver supply. They held derivative contracts that locked in prices and provided balance sheet stability. This strategy worked brilliantly in stable regulatory environments. But when Executive Order 14346 forced liquidation of those hedges, Samsung suddenly faced a different reality. The company now had to purchase silver on the spot market at prevailing prices with no hedging protection. 3 days after the crash, Samsung's procurement team discovered that physical silver available for immediate delivery in the quantities they needed was trading at significant premiums to the COMEX price. Their production costs had increased not because silver fundamentally became more expensive, but because they had been forced out of the derivatives market into the physical market. By February 2nd, Samsung had announced 6 to 8 week production delays on certain product lines due to commodity procurement challenges. This was not a Samsung-specific problem. Any corporation that relies on silver for manufacturing, solar panel producers, electronics manufacturers, medical device companies, automotive suppliers, faced the same vulnerability. If tariffs or regulatory changes forced them out of hedged positions, they would be exposed to physical market premiums that the paper price did not reflect. Meanwhile, a different group of buyers had been positioning for exactly this outcome. Between October 2025 and January 2026, central banks in China, Russia, and the United Arab Emirates had purchased a combined 47 million ounces of physical silver. Not derivative exposure, not ETF shares, allocated physical metal delivered to sovereign vaults. These were not speculative trades. These were strategic accumulation programs by entities that understood the paper market was becoming unreliable as a pricing mechanism. They were buying physical metal while paper prices were still suppressing premiums. They were taking delivery while Western investors were still comfortable holding financial claims. They were building positions before the system bifurcated completely. The Chinese purchases were particularly instructive. Between December and January, the People's Bank of China added 23 million ounces to reserves through the Shanghai Gold Exchange. These purchases occurred during a period when COMEX silver was rallying toward $117. Yet Chinese buyers continued accumulating despite rising prices. They were not trading, they were positioning. And on January 27th, when the COMEX crashed and physical premiums spiked, those positions proved their strategic value. For business decision makers, family offices, and corporate treasury managers, the implications were clear. The paper silver market now serves regulatory control objectives. Prices can be manipulated through margin requirements, forced liquidations, and coordinated institutional positioning. Legal immunity protects the exchanges and banks executing these strategies. The physical silver market reflects actual supply-demand economics. But access to physical metal at reasonable premiums requires advanced positioning, allocated storage, and direct relationships with refiners and dealers. The system has bifurcated. And January 27th, 2026 was not an isolated event. It was proof of concept. Executive Order 14346 establishes precedent for linking trade policy to commodity market intervention. The mechanism can be applied to palladium, platinum, rare earth elements, or any other strategic material that foreign corporations hold in hedged positions. The question for anyone holding precious metals exposure is no longer whether their investment will increase in value. The question is whether they actually own physical metal, or just a financial claim that can be liquidated by regulatory decree. Because when the next trigger comes, and there will be a next trigger, the paper market will move one direction, and the physical market will move another. The gap between those two prices is where fortunes will be lost, and where strategic positioning will be validated,